There is a financial mechanism at the center of the American insurance industry that your insurer has never explained to you, that your insurance agent has almost certainly never mentioned, and that the people who designed it have spent decades making sure sounds boring enough that you'll stop reading before you understand what it actually means. It is called the float. And once you understand it, really understand it, not the dictionary definition, but the operational reality of how it works inside the companies processing your claims, the way you interpret every interaction you've ever had with an insurance company will shift permanently. The hold music, the request for additional documentation, the claim marked pending for 3 months, the denial that arrived 9 days after you filed. None of it will look accidental anymore. Here is what I want to cover today. First, what the float actually is and where it comes from, because the textbook definition misses the part that matters. Second, who figured out how to use it as a primary wealth-building engine and what they said about it publicly, in their own words, in documents you can read right now. Third, how float optimization shapes the specific decisions your insurer makes about your specific claim. And fourth, the one number inside your own policy that tells you how aggressively your insurer is managing float against you, and how to find it in about 4 minutes. This video is not about getting angry at insurance companies. I'm going to give you the actual financial logic, sourced from earnings calls and court filings, and the investors who built fortunes on this system. Because the best way to protect yourself from a mechanism is to understand exactly how it works. Let's start with money that isn't yours yet. Part 1. What the float actually is. On the first of every month, or every quarter, or every paycheck cycle, you send your insurance company money. They don't immediately give it back. In fact, the entire business model of insurance is built on the gap between the moment they receive your money and the moment, if ever, they have to return any of it as a paid claim. That gap, the period during which they are holding your premium dollars and those dollars have not yet been paid out, is the float. If you have a home, a car, a health plan, and a life insurance policy, you might be sending 4 different insurance companies 4 different premium payments every single month. Every one of those companies is now holding your money. Some of them will hold it for months. Some will hold it for years. If you are lucky enough to go your whole life without a major claim, will hold it for decades. While they hold it, they invest it. That is not a detail. That is the business. A standard insurance company's income comes from 2 sources. The first is underwriting income, the difference between what they collect in premiums and what they pay out in claims. On most years, in most lines of insurance, this number is surprisingly thin. Sometimes it's negative. Insurers routinely price certain products knowing they'll pay out more in claims than they collect in premiums for that product line. That's not a mistake. The second source is investment income, the return generated by putting your premium dollars to work in the financial markets before any claims come due. Bonds, equities, real estate, municipal securities. The investment portfolio of a major insurer is enormous. United Health Group's investment portfolio held roughly $47 billion in assets as of their most recent annual report. Berkshire Hathaway's insurance subsidiaries, Geico, General Re, and others, held a float of approximately $169 billion as of 2023. $169 billion. That is money that belongs, in a sense, to policyholders. It represents future claims that haven't been paid yet. But until those claims are filed and approved, Berkshire is investing it. And the return on that investment goes to Berkshire's shareholders, not to the people whose premiums created the float. That is the mechanism. Before we talk about what it does to your claim, you need to hear it described by the person who most openly built a fortune on it. Because he said what no one in the industry usually says, and he said it in writing, in documents that are publicly available, over and over again for 40 years. Part 2. Warren Buffett explained this. Nobody listened. Warren Buffett has been describing the insurance float in his annual letters to Berkshire Hathaway shareholders since the 1970s. These letters are public. They are free to read. Millions of people have read them as investment primers. Almost none of those people read them as a primer on what insurance companies are actually doing with their money. In his 2004 shareholder letter, Buffett wrote, "Insurers receive premiums up front and pay claims later. In extreme cases, such as those arising from certain workers' compensation accidents, payments can stretch over decades. This collect now, pay later model leaves us holding large sums, money we call float, that will eventually go to others. He is describing your claims, your premium, the money that is, in his framing, eventually going back to you, sitting in his investment portfolio in the meantime, generating returns for his shareholders. In his 2019 letter, he described the float's impact on Berkshire's investment capacity even more directly. This float is cost-free to us if our annual losses and expenses are equal to or less than the premiums we receive. When that math works, we essentially get to invest other people's money for nothing. I want to be precise here, because Buffett is not confessing wrongdoing. He is describing a legal, structural feature of how insurance companies work. He is also, in a way that I find remarkable, describing it in exactly the terms that the industry usually tries to obscure, because investing your customers' money for free is the kind of sentence that sounds different when a policymaker hears it than when an investor does. The key phrase in that 2019 letter is, if our annual losses and expenses are equal to or less than the premiums we receive. This is the combined ratio, the percentage of premiums paid back out as claims and operating expenses. If it's below 100%, the float is free. If it's above 100%, the float has a cost. And here is where the float stops being an abstract financial concept and starts being the reason your claim is being handled the way it's being handled. Part 3. How float optimization shapes your claim. I want to walk you through the math the way an insurance company's CFO thinks about it, because this is the part that almost nobody explains to policyholders. If an insurer pays out a claim immediately, the day you file, full amount, no friction, the float ends. The money leaves the investment portfolio. The investment return on that money ends. If the insurer delays paying the claim by 90 days, marks it pending, requests additional documentation, routes it to a secondary review, that money stays in the portfolio for 90 more days. On a $50,000 claim, at a conservative 4% annual return on the investment portfolio, 90 days of additional float generates approximately $500 in investment income. $500 doesn't sound like much until you think about scale. United Health Group processed approximately 1.5 billion claims in 2022. Not all of those are large. But if the average claim in the portion they delay is $10,000, and the average delay they generate through friction is 60 days, and their investment portfolio returns 4% annually, the additional investment income from that delay pattern runs into the hundreds of millions of dollars per year. This is not speculation. The actuarial logic is published in insurance industry trade literature. Float optimization is taught in insurance company management training programs. The term appears in regulatory filings. It is a standard component of insurance financial management. What it is not, typically, is explained to the person on hold for 40 minutes waiting to find out why their claim is still pending. The claims decisions that feel arbitrary, the request for documentation you already submitted, the secondary review that adds 6 weeks to the timeline, the denial that you eventually win on appeal after 4 months of correspondence, have a financial logic behind them that is invisible to you, but entirely visible to the people making the decisions. Every day a claim is delayed is a day the float earns. Every claimant who gives up is a claim that never gets paid. Both of those outcomes increase investment income. One of them does it by delay. The other does it by permanent retention of premiums. Now I want to show you something specific about how property and casualty insurers, your auto insurer, your homeowner's insurer, report this to regulators, because this is the part you can actually check yourself. Part 4. The loss reserve and what it tells you. Every property and casualty insurance company in the United States is required to file something called a Statement of Actuarial Opinion with their state regulator each year. Inside that document, and inside the broader financial statement it's attached to, is a number called the loss reserve. The loss reserve is the amount the insurer has set aside to pay claims that have been filed but not yet paid, plus an estimate of claims that have been incurred but not yet reported. It is, in simple terms, the pile of money that represents future claim payments. The loss reserve matters to understanding the float for one very specific reason. Insurers have a significant financial incentive to set their loss reserves conservatively, lower than the claims will actually cost. A lower loss reserve means a lower reported liability, which means a stronger looking balance sheet, which means a higher stock price, which means executives whose compensation is tied to stock performance get paid more. It also means the money that should be sitting in reserve against future claims is instead sitting in the investment portfolio, generating float income. This is called reserve manipulation, and it has been at the center of some of the largest insurance regulatory actions in American history. In 2005, the New York Attorney General's office, at the time led by Eliot Spitzer, opened an investigation into bid rigging and reserve manipulation across the commercial insurance industry. The investigation resulted in hundreds of millions of dollars in settlements from major insurers, including AIG, Marsh & McLennan, and ACE Limited. The core allegation in several of the AIG cases was that the company had manipulated its reserves specifically to manage its reported financial ratios, keeping money in the float that should have been set aside for claims. AIG's fine from the New York Attorney General's office for these practices was $1.64 billion. That is not a fine for an accident. That is a fine for a system. I am not saying your insurer is currently engaged in reserve manipulation. State regulators do audit reserves. The practices Spitzer exposed led to meaningful reforms in reserve reporting. The environment today is different from 2005. What I am saying is that the financial incentive to under-reserve is structural and permanent, and that incentive shapes conservative reserve setting in ways that are legal, and legal doesn't mean neutral. The practical implication for you: if your property claim is taking longer to resolve than seems reasonable, request a copy of your insurer's most recent loss development triangle. That's the schedule that shows how their reserve estimates have changed over time compared to what they actually paid. It's a public document, filed with your state insurance department. What it shows you is how consistently the company has underestimated or overestimated its claims. A company that consistently under-reserves is a company that is structurally optimizing float at the expense of claim speed. It will take you about 20 minutes to find and about 5 minutes to read. No one in the industry expects you to do it. Part 5. Life Insurance and the Float's Longest Game. Everything I've described so far is most visible in health insurance and property and casualty insurance, because claims in those lines tend to happen within months or years of the policy being issued. Life insurance is different. A whole life policy purchased by a 35-year-old might not generate a claim for 50 years. The premium payments made over those 50 years, sitting in the insurer's investment portfolio, generating returns, compounding, represent a float with a time horizon measured in decades. This is not inherently predatory. Life insurers use the investment income from the float to fund the guaranteed death benefit. That's why the math works. The float is the mechanism, not the problem. The problem is what happens at the edges of the system, in the gaps between how life insurance is sold and how the float actually operates. Here is a specific example. In 2016, California's Department of Insurance completed a multi-year investigation into whether major life insurers were using state death records to stop paying annuity benefits when a policyholder died, but failing to use the same death records to proactively identify and pay life insurance death benefits to beneficiaries. The investigation found that several major insurers were cross-referencing the Social Security Death Master File, which lists people who have died, to terminate payments they owed outgoing, annuity payments to people who had died. They were not using the same database to find the families of people who had died and pay the life insurance they were owed. The money, the unclaimed death benefits, stayed in the float. MetLife, John Hancock, Prudential, New York Life, and others paid a combined total of over $500 million in settlements across multiple states for unclaimed property violations related to this practice. The California investigation alone resulted in $640 million in previously unpaid benefits being identified and returned. Let me be direct about what happened there. These companies knew which of their policyholders had died because they were using death records to stop paying out. They chose not to use the same records to start paying in. The unclaimed premiums, the death benefits that families didn't know to claim because they didn't know the policies existed, stayed in the investment portfolio. The float doesn't give that money up voluntarily. You have to claim it, which means you have to know it exists. If a parent or grandparent died in your family and you're not certain whether they held a life insurance policy, the National Association of Insurance Commissioners maintains a free policy locator service at NIC.org. Insurance companies are required to respond to searches through that service. Most families who use it find nothing. Some find policies worth tens of thousands of dollars that were sitting in float, because no one thought to look. Part 6. What the float means for how you should file. I want to be precise about one thing before I get to the practical part. The float is not illegal. It is not a secret. Warren Buffett has written about it in plain English in letters available on Berkshire Hathaway's website for the past 40 years. Insurance regulators understand it. State insurance commissioners understand it. The academic literature on insurance economics discusses it in detail. What it is systematically underexplained to the people whose money creates it. And the gap between what insurers know about the float and what you know about the float shapes every negotiation you will ever have with them. Every claim, every appeal, every settlement offer, every "we need additional documentation" letter. When you know about the float, certain things become clear. Speed is always on your side, never on theirs. When you delay filing a claim, you are extending the float at no cost to them. File the day the loss occurs. The clock that matters, the regulatory clock that governs how quickly they must respond to a filed claim, doesn't start until you file. Documentation submitted in a single complete package closes off the delay strategy. The additional documentation request adds weeks to the timeline and keeps the claim in pending status, which, as I described earlier, is float-friendly. A claim submitted with every piece of supporting evidence attached, in a format that makes it impossible to request more, forces a decision on a faster timeline. When a claims adjuster makes you a settlement offer within the first week of a large property claim, understand what that offer is. It is the present value of your claim discounted by their assessment of how long you'll fight and how likely you are to accept less than full value. They are offering you the float-adjusted settlement, the amount that, even after giving you less than you're owed, still generates better float income than the cost of a longer dispute. You do not have to accept it. You can request an independent appraisal. You can invoke the appraisal clause that is buried in nearly every property insurance policy and that almost no one knows exists. The appraisal clause means this: if you and your insurer cannot agree on the value of a covered loss, either party can demand an independent appraisal process in which each side hires an appraiser. The two appraisers select a neutral umpire, and the umpire's decision is binding. This process exists, it's in your policy, and it almost always produces a higher number than the initial adjuster offer, because the appraiser you hire has no float interest in settling low. Most people who've been through a large claim have never heard of it. Part 7. The one number to find before you do anything else. There is a ratio inside your insurer's annual report that tells you, more precisely than any other single number, how aggressively they are managing float against their policyholders. It's called the combined ratio. The combined ratio is the percentage of premiums that an insurer pays back out as claims and operating expenses. A combined ratio of 95 means they pay out 95 cents for every dollar they collect and keep 5 cents as underwriting profit on top of whatever they earn from the float. A combined ratio of 105 means they pay out $1.05 for every dollar they collect. Technically an underwriting loss, but often still profitable overall because the float income makes up the difference. Here is the number that matters. When an insurer's combined ratio runs significantly below 100, say, in the 85 to 90 range, it means they are collecting substantially more in premiums than they are paying in claims. That gap doesn't mean they're healthier. It often means they're denying more. The American Academy of Actuaries published an analysis of combined ratios across health insurance lines following the ACA's medical loss ratio requirement, the rule that health insurers must spend at least 80 to 85 cents of every premium dollar on actual medical care. Before that rule went into effect, some health insurers were running combined ratios in the 70s, paying out 70 cents on the dollar, keeping 30 cents, and still generating float income on top. The medical loss ratio requirement forced that number up. It did not eliminate the float incentive. It reduced the underwriting margin and shifted more of the financial optimization toward the investment side, toward holding premiums longer before paying them. To find your insurer's combined ratio, go to your state insurance department's website. Every state publishes insurer financial data. Search for your insurer's name and the most recent annual statement. The combined ratio will be in the financial summary. If your health insurer's medical loss ratio, the health-specific version of the combined ratio, is sitting right at the 80% floor required by law, that is the minimum they are legally required to return to you. They got as close to the floor as the law allowed and stopped there. If your property insurer's combined ratio has been running below 90 for 3 consecutive years, they are collecting substantially more than they are paying. Whether that reflects disciplined underwriting or aggressive claims management is a question worth asking before your next renewal. There is a version of this video I could have made that would have been easier to watch. One where the float is simply explained, where I tell you that insurance companies invest your premiums, and that's just how the industry works, and where I send you off feeling generally informed but not specifically changed. I didn't make that video because the float is not an abstract financial concept. It is the operational logic behind the hold music and the pending claim and the settlement offer that arrived before an adjuster had seen your property. It is the reason the industry's most successful investors spent decades saying, "We get to invest other people's money for nothing," in documents that nobody read as a warning. You read it now. The question I keep coming back to, and I'll leave this in the comments because I genuinely want to know what you think, is whether a system this clearly described, this openly documented, this consistently profitable for shareholders at the direct expense of claim speed for policyholders, is a system that needs reform or a system that is simply doing what financial systems do, and the answer is for you to know more. I don't have a clean answer. I have a combined ratio and a policy locator and an appraisal clause. Start there. Drop your float experience in the comments. The adjuster who showed up the day after the storm with a number in his hand before he'd seen the damage. The claim that sat pending for 5 months. The settlement offer that arrived before you'd finished crying. I read every one. Because the next video is about what happens when an insurance company's float management goes so wrong that the state has to step in and take over. And the names of the companies it's happened to recently are names that are in people's mailboxes right now. Subscribe, because that video is almost ready. In insurance, the most expensive thing you don't understand is the thing they've spent 40 years making sure sounds too boring to explain.